Here's a question that should terrify every stock market investor right now. What if the safest investment of 2025 just crushed your entire portfolio's returns? Gold ETFs didn't just beat the stock market this year, they absolutely demolished it, with some funds delivering returns over 140%, while the S&P 500 barely managed 15%. And before you think this rally is over, you need to understand why 2025 might just be the beginning of gold's dominance. I'm about to show you the 5 gold ETFs that turned $10,000 into over $24,000 in less than 12 months. But here's what Wall Street doesn't want you to know. These aren't your grandfather's gold investments. These are leveraged plays on one of the most powerful financial shifts happening right now. And if you don't understand the difference between physical gold ETFs and mining stock ETFs, you could be leaving massive returns on the table. Let's start with the elephant in the room. Gold just hit over $4,100 per ounce in November 2025, up nearly 60% for the year. Meanwhile, the S&P 500 gained around 15%. That's a 4-to-1 outperformance. But here's where it gets interesting. While gold itself rose 60%, certain gold mining ETFs exploded by 140% to 146%. How is that even possible? It's called operational leverage, and it's the secret weapon that separates average investors from those who actually understand how to profit from gold's bull run. Think of it this way. When gold rises from $3,000 to $4,000 per ounce, that's a 33% increase in the metal's price. But a mining company's costs don't suddenly jump 33%. Their labor costs, equipment costs, and most operational expenses stay relatively flat. So when gold jumps $1,000 per ounce, every single ounce they mine becomes $1,000 more profitable. That extra $1,000 flows almost entirely to their bottom line, causing their stock prices to skyrocket at 2, 3, sometimes 4 times the rate of gold itself. But before we dive into the 5 ETFs that are capitalizing on this leverage, you need to understand something crucial about how gold ETFs actually work. Because not all gold ETFs are created equal, and choosing the wrong type could mean the difference between modest gains and explosive returns. There are 3 distinct types of gold ETFs, and each one plays a completely different game. First, you have physical gold ETFs. These funds actually own real gold bars sitting in vaults, typically held by massive banks like HSBC or JP Morgan. Every share you buy represents a tiny slice of actual 99.99% pure bullion. When gold goes up 10%, your ETF goes up roughly 10%. Simple, stable, and backed by the real metal. These are your pure gold plays. Then you have gold miner ETFs. This is where things get spicy. These funds don't own any gold at all. Instead, they own stocks of companies that mine gold. And this is where that operational leverage I mentioned earlier kicks in hard. When gold rises $100 per ounce, a mining company doesn't see their costs rise by $100. Their expenses might increase by $10 or $20, but they're selling their gold for $100 more. That difference, that margin expansion, is pure profit. And it's why mining stocks can surge 50%, 80%, even 100% when gold itself only rises 20 or 30%. The third type? Explorer ETFs. These are the wild cards. They focus on small companies that are actively searching for new gold deposits. These aren't even producing gold yet. They're drilling, testing, hoping to strike the next major find. When they do discover gold, their stock prices can absolutely explode. We're talking potential triple-digit gains in months. But if they come up empty, the opposite happens. High risk, high reward. Now here's what makes 2025 so special and why these 5 ETFs we're about to discuss have absolutely crushed it this year. We're witnessing a perfect storm of factors pushing gold into what analysts are calling a structural bull market. This isn't a temporary spike. This is a fundamental shift in how the world's largest institutions are thinking about money itself. Factor number 1, central banks are buying gold at record levels. We're not talking about a few tons here and there. In the third quarter of 2025 alone, central banks purchased 220 tons of gold. For the first 9 months of the year, they've added 634 tons to their reserves. That's entire nations. China, India, Brazil, Kazakhstan, literally converting their dollar reserves into physical gold. Why? Because they're hedging against dollar weakness and reducing their dependence on U.S. currency. When the world's central banks are this aggressive, it creates a structural floor under gold prices. Factor number 2. The Federal Reserve is cutting interest rates. After years of keeping rates high to fight inflation, the Fed has already cut twice in 2025, and markets are pricing in an 85% probability of another cut in December. Why does this matter? Because gold doesn't pay interest. When rates are high, you can park money in treasury bonds and earn 5% risk-free. But when rates drop to 2% or 3%, suddenly gold becomes much more attractive. There's less opportunity cost to holding it. Lower rates make non-yielding assets like gold significantly more competitive. Factor number 3, the dollar is weakening. The U.S. dollar index has been under pressure throughout 2025 as global tensions rise and countries diversify away from dollar-based reserves. When the dollar falls, gold priced in dollars becomes cheaper for foreign buyers, driving up demand and prices. And factor number 4, geopolitical chaos. From conflicts in the Middle East to tensions in Eastern Europe to trade wars in Asia, uncertainty is everywhere. And when uncertainty rises, investors flee to safety. Gold is the ultimate safe haven. It's been money for 5,000 years, and it's no one's liability. You can't print more gold. You can't devalue it with monetary policy. These 4 factors have created an environment where gold isn't just rising, it's accelerating, and the 5 ETFs I'm about to show you have positioned themselves perfectly to capture this massive wave. Let's start with the absolute monster performer of 2025, the VanEck Junior Gold Miners ETF, ticker symbol GDXJ. This fund has delivered a staggering 146.29% return year-to-date as of November 26, 2025. Let me repeat that, 146.29%. If you invested $10,000 at the start of the year, you're now sitting on $24,629. That's not a typo. What makes GDXJ so explosive is its focus on junior mining companies, smaller early-stage miners with names like Pan American Silver, Alamos Gold, and B2 Gold. These aren't the giant established producers. These are the scrappy high-growth companies that are incredibly sensitive to gold price movements. When gold moves, they move harder and faster. That operational leverage we talked about, junior miners have it in spades because they're operating on thinner margins to begin with. The fund manages $8.86 billion in assets spread across more than 80 different holdings. So you're getting broad exposure to the junior mining sector without the risk of picking individual stocks. The expense ratio is 0.51%, which is reasonable for a specialized fund. And here's a nice bonus. It pays a dividend yield of about 1.06% annually. You're getting paid while your investment compounds. But here's the thing about junior miners. They're volatile. When gold dips, GDXJ can fall harder than physical gold or large cap miners. But when gold rallies like it has in 2025, there's simply no better way to amplify your returns. Next up is GDXJ's bigger, more stable cousin, the VanEck Gold Miners ETF, ticker GDX. While GDXJ focuses on juniors, GDX owns the giants of the gold mining world. Companies like Newmont Corporation, Barrick Gold, and Agnico Eagle Mines. These are the blue chips of gold mining, with operations spanning multiple continents and decades of experience navigating commodity cycles. GDX has delivered a phenomenal 140.60% return year-to-date as of November 26, 2025. Slightly lower than GDXJ, but still absolutely crushing the broader market. If you started the year with $10,000 in GDX, you're looking at about $24,060 right now. Nearly identical results, but with a smoother ride along the way. What I love about GDX is the combination of growth and stability. You're getting exposure to the biggest, best-run miners in the world. These companies have weathered commodity cycles before. They know how to manage costs, optimize production, and return cash to shareholders through dividends and buybacks. The fund manages a massive $23.96 billion in assets across about 65 different companies. The expense ratio matches GDXJ at 0.51%, and it pays a dividend yield of about 0.49%. Not huge, but a nice steady income stream on top of the capital appreciation. For investors who want serious gold mining exposure but don't want the extreme volatility of junior miners, GDX is the sweet spot. Now let's talk about global diversification. The iShares MSCI Global Gold Miners ETF, ticker RING, takes a different approach than the VanEck funds. While GDX and GDXJ are heavily focused on North American miners, RING casts a much wider net across the entire planet. This fund invests in gold miners from Canada, Australia, South Africa, and beyond, giving you truly international exposure to the gold mining sector. Ring has delivered a stellar 131.54% return year-to-date, slightly behind the VanEck funds, but still absolutely dominant compared to traditional stock indexes. Turned $10,000 into $23,154 in less than a year. That's the power of diversified global gold exposure working for you. Here's what separates Ring from the pack: lower cost. The expense ratio is just 0.39%, noticeably cheaper than both GDXJ and GDX at 0.51%. Over time, those fee differences compound significantly. Less money going to fees means more money staying in your pocket. The fund holds around 40 companies, with familiar names like Newmont and Barrick still in the mix. But you're also getting exposure to international miners you won't find as prominently in U.S.-focused ETFs. It pays a dividend yield of about 0.85% and manages over $2.6 billion in assets. Number 4 on our list is the Sprott Gold Miners ETF, ticker SGDM. This fund takes a more selective, factor-based approach. Instead of simply tracking the biggest gold miners by market cap, SGDM uses a custom screening process to identify miners with stronger fundamentals, higher revenue growth, better balance sheets, and solid operating performance. It's an active strategy wrapped in an ETF structure. SGDM has delivered an impressive 122.26% return year-to-date as of October 31st, 2025. Still more than doubling your money, but with a more concentrated, quality-focused approach. The fund holds just over 24 companies, meaning each position carries more weight than in broader funds with 60 or 80 holdings. The expense ratio is 0.5%, almost identical to GDX and GDXJ, and the dividend yield is smaller at around 0.43%. The fund manages about $628 million in assets, making it smaller than the VanEck giants, but still plenty liquid for most investors. What makes SGDM interesting is that quality focus. By screening for better fundamentals, the fund theoretically positions itself to outperform during both bull and bear markets. Companies with strong balance sheets and efficient operations can weather downturns better and capitalize harder when gold rallies. The trade-off? More concentration means bigger swings. And finally, we arrive at the wild card of this list, the Global X Gold Explorers ETF, ticker GOEX. This fund invests in companies that aren't just mining gold today, they're actively exploring for new deposits. These are the prospectors, the drillers, the companies trying to make the next big discovery that could change their fortunes overnight. GoEx has delivered approximately 120% returns year-to-date in 2025, putting it right in line with SGDM. But the path to get there has been far more volatile. The fund holds around 50 companies, Many of them smaller names you won't find in GDX or RING. Assets under management are modest at about $115 million. The expense ratio is higher at 0.65%, reflecting the active research and specialized focus required to track exploration companies. The dividend yield is very modest, just 0.4%, because most of these companies are reinvesting every dollar they have into drilling and exploration, not paying out shareholders. Here's the thing about Explorer ETFs. When they hit big. A successful gold discovery can send a small explorer's stock price up 100%, 200%, even 500% in a matter of months as the market revalues the company. But the risks are real. Exploration is expensive, capital intensive, and most holes come up empty. That's why GoEx spreads your bet across 50 different companies. You're not relying on one company to strike gold, you're betting on the entire exploration sector. So here's what all 5 of these ETFs have in common. They've absolutely crushed the broader stock market in 2025. But more importantly, they represent different strategies for capturing gold's bull run. GDXJ gives you maximum leverage through junior miners. GDX offers blue chip stability with serious upside. RING provides global diversification at lower cost. SGDM focuses on quality fundamentals. And GOEX swings for the fences with exploration upside. But let's talk about what comes next, because this is where it gets really interesting. Is this gold rally sustainable, or are we looking at a bubble ready to pop? Here's what the data tells us. Gold has now risen for 4 consecutive months heading into December 2025. Central banks continue buying at record levels with no signs of slowing. The Federal Reserve's rate-cutting cycle is likely to continue through 2026 as economic data softens. Geopolitical tensions show no signs of easing. If anything, they're intensifying. And perhaps most importantly, the structural shift away from dollar dominance is a multi-year, possibly multi-decade trend. Analysts at major banks are projecting gold could hit $5,000 per ounce by 2026. Some firms are even more bullish, targeting $4,500 to $4,900 in the near term. If they're right and gold continues climbing from current levels around $4,170, the mining stocks we've discussed could see another massive leg higher. Remember that operational leverage? If gold rises another 20% to $5,000, well-run mining companies with stable costs could see their profits and stock prices surge 40%, 50%, or more. That's the multiplier effect in action. But here's what you need to understand. Volatility works both ways. Gold mining stocks are not buy-and-forget investments. When gold corrects, miners correct harder. In the past month, GDXJ pulled back over 5% as gold consolidated near its highs. This is normal and expected. These are cyclical assets tied to a commodity that can swing 2% or 3% in a single day. That's why position sizing matters tremendously. Gold and gold miners should be a piece of your portfolio, not the whole thing. Most financial advisors suggest anywhere from 5% to 15% allocation to precious metals and related equities, depending on your risk tolerance and investment timeline. If you're someone with a long time horizon and the ability to stomach volatility, the leveraged upside of junior miners through GDXJ might make sense. If you want exposure with less wild swings, GDX or RING could be better fits. If you believe in active quality selection, SGDM deserves a look. And if you're willing to accept higher risk for potentially explosive returns, GoEx brings exploration upside. Here's the bottom line. 2025 has proven that gold can outperform stocks, and gold mining ETFs can outperform gold itself. The 4 factors driving this rally, central bank buying, falling interest rates, dollar weakness, and geopolitical uncertainty, are not going away anytime soon. If anything, they're intensifying as we head into 2026. These 5 ETFs, GDXJ, GDX, RING, SGDM, and GOEX, have positioned themselves perfectly to capture this wave. They've already delivered triple-digit returns this year. And if the gold bull market continues, which the structural data strongly suggests it will, we could be in the early innings of something much bigger. This could be a multi-year supercycle. So the question isn't whether gold ETFs can outperform stocks. 2025 already answered that with a resounding yes. The real question is, are you positioned to capture what comes next? Because while everyone else is chasing tech stocks and watching the S&P 500 inch higher, gold is quietly building the foundation for what could be the greatest wealth transfer of the decade. And these 5 ETFs are your front row seat to the show.